Then we also welcome on board Saurabh Mukherjea from Marcellus Investment and talk about what he's making of the market. Saurabh, hi, good morning. Hope all things safe.
We're all right. We're holding up in Marcellus and trying our best to help others who might need a little bit of help from us.
Yeah, indeed. Saurabh, what's happening with the market? That's been ignoring completely just about any negative news. It's baffling to see the market resilience. I mean, soon we're going to make it back to 15k.
I guess, Aisha, investors learned from last year, right? They learned that even if you have 3 months like we did last year, right? April, May, June, where the economy has been shut down. In fact, the economy contracted by 25%. They learned that in spite of that, market-leading franchises can come back very strong. And we saw through the last 7-8 months of FY21 and the final 7-8 months of FY21, we saw investee companies of ours such as Asian Paints, Pidilite, Divi's Lab, Dr. Lal Path Labs, Relaxo, HDFC Bank, Kotak Bank, Bajaj Finance, post earnings growth of 30-40%. So I suppose, whilst we had sort of stayed invested throughout, a lot of people had sold these stocks in the panic of February, March last year. And I guess people don't want to repeat the same mistake. So everybody is, as I think, shell-shocked by the scale of what's happening around us. The humanitarian tragedy obviously is evident. But at the same time, people are saying we learned from our mistakes last year. We don't want to make the same mistake twice and sell in a panic for what will be a 2-3 month, very difficult situation for 2-3 months. But you can't extrapolate that beyond a point, and market-leading franchises will actually gain market share in these 2-3 very difficult months that we are all living through.
Yeah, absolutely. In that strong show and resilience, Saurabh, one has seen that metals continues to be a rip-roaring theme. I mean, not to say that it's already not performed all of 2020, but given that steel companies are continuing to take those price hikes, commodity is in a charging bull run. Having said that, how much more can these stocks actually move? And is the best behind us? Or would you say that we're yet to see what's best of the metal stocks?
Look, I'm not an expert in commodity prices, and it's commodity prices which actually drive the share prices of metals and mining stocks. So we can sit here and pontificate about earnings growth of Indian metals and mining stocks, but the main engine of a metal share price of a metal stock like a Tata Steel or JSW Steel, the main engine of the share price is the price on the London Metal Exchange or in the global commodity markets. And global commodity markets are on a tear because of roaring economic recoveries in America, in Europe, in China. And to the extent that we're in the early stages of a global economic recovery, it could well be that there is more steam left in metal prices, but I'm no expert on them. What always sort of foxes me a little bit is why investors choose to play metal prices through stocks rather than buying the underlying commodity. Inherently, what you're doing is you're buying a company which is producing by definition a commodity. And if you have such clarity on commodity prices, then by all means invest in the commodity rather than the stock price. So I don't think the Indian economy has that much to do with the super show that metal stocks have posted. And to the extent that the global economic recovery looks likely to continue over the next couple of years, for all you know, you might have a good couple of years ahead of metal stocks.
Hi Saurabh, good to connect with you. Saurabh, the underlying difference between same time last year when the first wave had hit us and the second wave is now impacting us, the human tragedy is so high that I fear that could this have an impact on retail franchise, which is that the number is so strong, there are mortality rates, it could start impacting the income segment. Also, it will have impact on productivity. So medically, if I look at the numbers, the sheer proportion and the fact that it is hitting a younger population also, could that lead to retail delinquencies?
So obviously this quarter, the quarter we're living through, will be a very difficult quarter. I think barring pharma and FMCG, probably all other types of consumption will see a pretty significant hit. I don't think people are rushing out of their houses to buy clothes or washing machines or cars in this sort of climate. But you got to remember that for any company share price, whether it is whether it is Maruti or whether it is HDFC Bank, in effect, the share price discounts the next 20 years. If out of the next 20 years, you take away, say, 6 months of earnings, you're basically knocking off fair value by 2 to 3%. And then the next leg of the maths is, if in those 6 months where economic activity or the relevant sector, whether it be apparel or consumer durables or cars, if the relevant sector takes a hit and the company one has invested in, say for the sake of argument, you've invested in Maruti, if Maruti gains market share, say even if Maruti gains 10% market share, which is very believable, right? In this sort of incredibly stressed climate, a champion franchise like Maruti could gain 10% market share, then the actually maths reverses. And because the maths reverses because once you get over a 3-6 month period of stress, that market share gain becomes permanent and fair value of Maruti actually moves up because of the crisis. I think it's that counterintuitive piece that a lot of people didn't understand last year. And I think this is why this year they're so reluctant to sell. They've figured out that in times of stress, the market leader might have 3 months of zero earnings, but the market share gains that he makes become long lasting, and they actually give a fillip to the next 5, 10, 15-year earnings growth, thus actually boosting the value of the franchise rather than suppressing it. So absolutely near-term consumption could be under pressure. Most likely it will be this quarter. But the market share gains that these franchises are gathering, right? You can just look at RBI credit offtake data. It's barely 6-7%. HDFC Bank, Kotak Bank are reporting 15 to 20% credit growth quarter after quarter after quarter. They will not relinquish those market share gains. So you're pushing up the fair value of these franchises on a permanent basis. And I think that's what investors like us are trying to benefit from.
Okay, it's a great point. What will be the impact of high commodity prices on commodity consumers, whether it is autos or a company like Pidilite, which you track, or for that matter, any company which in a sense now is really working and reworking the numbers together, trying to digest and trying to pass on the impact of commodity prices. I mean, even a company like Pidilite will feel the hit of high commodity prices. Maruti, we know, has already started indicating that, look, margins are under tremendous pressure because of high raw material prices.
Absolutely. So this is where the power of the barriers to entry a company builds comes very useful. So obviously, in an economic recovery like the one we are living through, I think, believe it or not, globally there is a roaring economic recovery. There will be one in India once we are able to get the vaccination situation under control. So in a roaring economic recovery, you're bound to see input cost inflation, right? So far, it's been commodity prices. My reckoning is in the next 12 months, wage cost inflation will also come through. Now, if you have built barriers to entry, if you're a market leader with very powerful barriers to entry so that the competition can't really punch on a level footing with you, you're able to push through price hikes to protect your margins. You might take, say, a 3-month, 6-month operating margin hit. But if you look at franchises like Pidilite, you look at franchises like Asian Paints, you look at franchises like Maruti, you'll see that over a 3-5 year period, very rarely will their operating margins go down because of input cost inflation. Why? Because they've got the muscle, they've got the barrier to entries to push through the price hike onto the consumer. And that's why investing in market-leading franchises remains a very durable proposition. In a bull market, and we've had a 50-55% rally in the market in the last 12 months, so difficult to call it anything other than a bull market. In a bull market, it's very tempting to go down the market cap spectrum and buy lower quality franchises. But I think, Nikunj, as you're rightly saying, low quality franchises can't protect you from input cost inflation. The champion franchises, such as the ones we're discussing, give you that protection and allow you to benefit from the economic recovery. The top line benefits of the economic recovery flow to the bottom line of the champion franchise. It does not flow to the bottom line of the second rung franchise.
One stock which has done incredibly well for you, my compliments, I'm sure our viewers and your investors must have made money, is Alkyl Amines. The second one was Garware. But these names were discussed 1 year ago. When Saurabh Mukherjea comes on air, people prompt me, Bhaiya, naya stock pucho.
So we've been steadily building up our position further in fine organics over the last year or so. It's very similar to those two stocks you mentioned, even very similar to Garware in the context of fishing nets, and alkylamines in the context of aliphatic amines. But fine organics makes the emulsifiers and the antifungal agents which go into the breads and baked products that all of us watching this program consume. By far the largest player in that market of supplying food additives, emulsifiers, and antifungal agents for baked products. We also have a very strong presence in supplying specific inputs which go into aerated drinks. I think the market leader there as well in supplying specific inputs which go into the cold drinks, the aerated beverages that people like us have. And increasingly, they have turned this into not just a market-leading domestic franchise, but into an export franchise. And these products are called oleochemicals. They're made from palm oil derivatives, that they don't have petrochemicals or animal fats in it. And increasingly, therefore, fine organics' products are finding a global market where environmentally conscious Western consumers are saying, I don't want to have my products have animal fat based inputs. I don't want petrochemical based inputs. And my reckoning is beyond the domestic monopoly, which gives them 30-35% ROCs and consistent growth of 20% in their business. I think there's a powerful export franchise as well. Indian promoters have built this up with lots of hard work over 50 years. And I think this could potentially become a multi-bagger play in our portfolio. So well-run company, debt-free company, listed for the last 3 years or so. I think anybody watching it should have a look at it. We've built a substantial position in it.
Okay. In fact, you've consistently been talking about fine organics with us as well, Saurabh. I want to understand, and I know you're not a short-term investor, I know that, and I know that your view on the markets in the long term also remains intact in terms of how you look to invest with a longer-term perspective. But tell me, in the interim, in the sort of shorter term for now, given the way things are stacking up and the uncertainty that prevails, is there a downside risk, and one that would worry you? I mean, in the sense, could it be that extreme, or do you feel markets have enough maturity to really withstand any kind of shocks and maintain some kind of range over even the next 6 months to a year? Let's talk about 6 months, because there's a lot of uncertainty that seems to be looming right now.
So I think for the reasons you mentioned, my view is that over a 6-12 months, we're on a pretty solid footing. I will give you the risks in a minute, but let me just quickly explain why I believe we're on a pretty solid footing. First off, we have a very powerful economic recovery. I think this is probably the strongest economic recovery in a generation that we are seeing in America, in Europe, and even in China. Right? So that sort of global economic tailwind will help us as once we get over the trauma of what we are currently living through. The second point is central banks, Fed, our central bank, are making it relatively clear that they will keep money cheap for a while. They're even making it clear to the point of subtly telling you and me that we are going to disregard inflation and focus on reviving the economy. That gives a lot of visibility to investors about the cost of capital over a 12-month horizon. Money is cheap. In fact, it's the cheapest we've ever had in our country, the lowest cost of capital in our country. And that will unquestionably help the economic recovery in our country. And the third piece is, you've got a situation where, and this is very difficult to put up, you're synchronizing the global economy courtesy COVID. Right? One of the biggest challenges in economics is coordinating between different parts of the economy. So if I'm a supplier to Maruti, I've got no idea, should I be putting up a new plant? Will Maruti give me more orders? Maruti itself doesn't know, will the customer want to buy cars? COVID is synchronizing it, because people are saying, yes, we want to buy cars. Money is cheap. We don't want to use public transport. We want to have our own cars. Maruti is telling its suppliers, build more capacity. The suppliers are putting up more capacity. They're calling up the steel supplier and saying, I need more steel. The steel companies are planning their capex, right? This sort of coordination is very hard to achieve. And COVID has serendipitously given all of us that. That being said, what are the risks we are looking at? First off is, especially in our country, if the fiscal situation continues to deteriorate, we could end up seeing both pressure on the currency and inflationary pressures come through, right? Because if your economy is not producing enough and the government is spending money to keep the lights on, obviously that will create inflationary pressures. That does become a challenge because, as Nikunj had said 5 minutes back, beyond the point, if inflation becomes 7, 8, 9%, it will start hitting the stock market, both because of fears on operating margin pressure and because of fears of interest rate hike and currency devalue. So I think the first concern I have on the macro side is how badly will the fisc suffer? How quickly will we end up seeing inflation move towards double digits? And the second piece is, we honestly, we're a little bit in the dark on how long will it get to get the vaccination numbers up to 5 million a day. We're all reading in the papers that it was 3 million 2 weeks back. Now it's 1.5 million vaccines a day. Can we really, can we get it up to 5 million a month out, 2 months out? I think I'm as much in the dark as anybody else. And if we screw this up, if we mess this up, we can't get 5 million vaccines a day going by, say, a month hence, then I think we will have pressure on the stock market.
Okay, that's what I wanted to hear, Saurabh, because that also helps to give us a real picture of what's really happening on ground and how possibly we could see the market reaction corroborating with that. Okay, a couple of the other pockets that you had earlier mentioned included dark horses in IT, for example, and that's a segment that continues to be robust. So I'm not sure there's any change in the view there, but just to touch upon it once again, in terms of a pocket of the market that you're bullish on.
I think both IT and pharma, I think these are sectors that have a very positive outlook on. This is probably the strongest IT demand environment that we've probably seen in our country for 11, 12 years. You can see it in the numbers that not just our investee companies like TCS are posting, but even say Infosys is posting. Pharmaceuticals, we have Divi's Lab in our portfolio, continues to do well. We've discussed on your channel before why we believe the specialty chemical sector in totality, I think that's potentially a 10-year boom, very similar to where specialty chemical seems to be very similar to where IT was 20 years ago, where the world wants to shift its specialty chemicals to India. Thankfully, we've got a big population of skilled process chemists. So these sectors, very little pandemic impact, very little impact of the second wave. Their life continues. Their numbers, I think, will continue to be very healthy. And that in a nutshell, therein lies, I think, the story for the broader economy. We are all part of a global economy. Thankfully, the global economy is coming out of COVID, and hopefully we too, 3 months hence, will be in a similar position.
All right, Saurabh, appreciate your time. Always good to get into an engaging conversation with you. I must say that every time my belief in India shakes, I just need to dial you and get convinced about it.
Thanks. Well, thank you. Very kind of you guys to host us. Thank you very much.